Hey guys, Marcus Carter here with GNT Financial. Thanks for joining us today on this video. And I'm excited today to talk to you guys about what happens when a borrower defaults or when a loan goes into foreclosure. So the first thing that we want to think about is you as the lender or as the investor have a security instrument in that property, and that's the deed of trust that's recorded against that property. And in addition to that, we have a third-party servicing company that's acting on your behalf and in your best interest to make sure that your investments or your trust deed is protected. So what they will do in the event of a default, they will effectively start the foreclosure process. And that foreclosure process is the remedy to protecting the investor, but also to making sure that the borrower actually can get their equity out of that property. So once a borrower goes into default, ultimately the clock starts ticking. And the servicing company will send out a notification. They will file a notice of default. 90 days after the notice of default is filed, they can file what's called a notice of trustee sale. And 21 days after the notice of trustee is filed, they can actually take the property to auction. So, and there's a lot of postings and different procedures that have to take place during that time frame. It's important to note that the note, even though the borrower may not be making payments, is still accruing interest. So your investment in that property is actually still accruing interest, even though the borrower is not making payments. In addition to that, you're also collecting late fees, potentially default interest, which is a higher interest rate than what the note is written at, and other fees and potential penalties. So if during that time frame the borrower doesn't bring that loan current or sell the property, and the loan goes all the way through to an actual foreclosure sale, there's two things that can happen in a foreclosure sale. The property can sell to another investor at auction, in which case the lender, or the investor in this case, will get paid off through the auction. The second thing that could happen is the property doesn't sell and it becomes transfers to the actual beneficiary through a mechanism called a trustee's deed, in which case the lender or the investor would actually become the new rightful owner of that property. And then you'd be free to do with that property whatever you chose to do. You could rent it, you could lease it, you could move into it, you could sell it, do whatever you want. So that really is the remedy in the event that a loan or a trust deed goes into default. One of the things that's important to note in trust deed investing is that there is an equity cushion. And that equity cushion is really important. That's determined in the underwriting process. So when we fund a privately funded trust deed, the loan to value typically is no more than 65%. In other words, the loan is at 65% of that value of the property. So on a $100,000 property, as an example, we would lend no more than $65,000 on that property. So what that does is it gives us a cushion for fluctuations in value, or if we had to foreclose on that property, so that we're ensuring there's enough equity in that property that your investment is always protected. And that's the goal of good underwriting and good trust deed investing, is to make sure that your underlying investment is always protected. Hey, thanks for watching this video today. If you have more questions, if you're interested in investing in trust deeds, give us a call at the number below. And thank you for watching this video, and please make it a great day.